The financial media thrives on distraction. Every day, it pulls your attention toward interest rate debates, Federal Reserve speeches, and flashing charts of tech stocks. The implication is subtle, but powerful. The world is controlled from a few terminals in New York, and if you just listen closely enough, you'll understand where prices come from. That belief is convenient, and that's exactly why it's wrong. While analysts argued over basis points and algorithms traded paper at light speed, something far more important unfolded quietly in the physical market. Silver inventories were shrinking, premiums were rising, metal was leaving vaults and not coming back. None of this showed up clearly on the screens most investors watch, but the stress was building underneath the surface. For months, we tracked this tightening with hard data, not opinions. Vault withdrawals that didn't reverse, supply gaps that refused to close, a slow, deliberate drain that suggested intent, not randomness. We knew silver was being absorbed. The only question was by whom. It wasn't hedge funds. They deal in leverage, not logistics. It wasn't tech companies chasing growth narratives, and it wasn't central banks, at least not in the usual way. When the answer finally emerged, it forced a complete rethink of global supply and demand. The buyer wasn't an institution. It wasn't a corporation. It was a nation acting with scale and urgency, not investing, accumulating. This wasn't cultural buying or seasonal demand. It wasn't speculation. It was strategic removal of metal from circulation. And because silver is a global asset with a finite above-ground supply, that decision matters far beyond one border. When physical silver leaves the market, it doesn't recycle through paper systems. It disappears from availability. The game board shrinks, and everyone still trading contracts is suddenly playing musical chairs with fewer seats. This is where the real story begins. Not with interest rates or headlines, but with a physical vacuum forming beneath the paper price, quietly pulling the entire system out of balance. Once the buyer revealed itself, the numbers stopped being abstract and started becoming uncomfortable. Trade data doesn't lie, and what surfaced rewrote every assumption still floating around the silver market. In just the most recent stretch of ongoing months, India imported roughly $5.9 billion worth of physical silver. Not futures, not ETFs, metal that had to be refined, insured, shipped, and received. Pause on that figure for a moment. Silver is not a large market. It doesn't take much to move it. Historically, from the last stable cycle through the years that followed, India averaged about $1.5 billion of silver imports over an entire year, 12 months. Now compare that to nearly $6 billion absorbed in a fraction of that time. That isn't a marginal increase. It's a fourfold explosion in demand. This is what a step function change looks like, not a smooth curve. A vertical move, a collective decision made at scale to exchange currency for metal immediately and without hesitation. And when you compare this buying spree to what was already considered a record year in the past cycle, the current pace still towers above it. That distinction matters. Because speculation ebbs and flows, strategic accumulation does not. A move of this size tells you something fundamental has shifted in mindset. This is not price chasing. This is preemption. It's the behavior of a buyer who doesn't care about short-term volatility because availability matters more than price. When that mindset takes hold, traditional valuation models break down. And here's the part most Western analysts miss. This metal doesn't come from nowhere. It doesn't teleport. Every ounce imported by India is an ounce removed from global circulation. Pulled from refineries, vaults, and warehouses that supply paper markets elsewhere. When one buyer absorbs months of global production in a compressed window, the buffer disappears. That's why this matters outside of India. Silver is global. Supply is finite. When one participant acts with urgency and scale, everyone else inherits the consequences. The paper price may pretend nothing has changed, but the physical market already knows better. The whale didn't surface to trade. It surfaced to take possession. And once possession changes hands, the rules change with it. As the numbers became impossible to ignore, familiar excuses rushed in. Analysts leaned on the same old narrative festivals, jewelry, cultural demand. It sounds harmless, comforting, and completely inadequate. You do not import billions of dollars worth of silver in a compressed window for decoration. Scale matters, timing matters, and this scale points to something structural. This is not consumer demand. It is industrial stockpiling and defensive accumulation. India isn't shopping, it's securing supply. The country is accelerating infrastructure development, expanding power grids, scaling solar capacity, and pushing hard into electronics manufacturing. Every one of these sectors depends on silver, photovoltaic cells, electrical contacts, advanced components, without reliable access to metal production stops. Industrial buyers understand a rule paper, markets ignore shortages arrive suddenly. When they do, price becomes secondary, availability becomes everything. That is why this buying is happening now regardless of short-term volatility. This is demand inelasticity in real time. Dips are not warnings, they are invitations. Every pullback is treated as a chance to secure material before it disappears. This behavior doesn't come from speculation, it comes from foresight. And capital inside India is already responding. Money is rotating toward assets tied to physical reality rather than financial promises. That rotation confirms what the trade data is already telling us. This is not tradition, it is preparation. A shift from confidence in paper systems to reliance on physical necessity. And once that shift begins, it rarely reverses. When physical demand shifts, capital never stays still. Money moves first, headlines follow later. And inside India's financial markets, the signal is already flashing. Metal and mining stocks are outperforming the broader market in a way not seen in many years. This is not about absolute gains, it's about relative strength. When mining companies begin to beat banks, consumer stocks, and technology, it marks a change in priorities. Capital is no longer chasing growth stories. It is positioning for scarcity. The ratio between metal producers and the general equity market has climbed to levels that historically only appear during periods of supply stress. This is not excitement, it is selection. Investors are deliberately rotating away from paper assets and toward companies tied to physical extraction and processing. This rotation mirrors what we see in the silver flows themselves. It is the financial reflection of industrial accumulation. When decision-makers anticipate shortages, rising input costs, and geopolitical friction, they do not wait for central bank guidance. They act early. More importantly, this behavior exposes a flaw in conventional thinking about inflation. Supply-driven inflation cannot be solved with interest rates. Higher rates do not create new mines. They do not speed up permitting. They do not increase above-ground inventories. In fact, they often delay new supply by raising development costs. That creates a feedback loop. Tight supply drives prices higher. Higher rates slow new production. Scarcity persists. Assets tied to real resources benefit not because of speculation, but because they sit upstream of a constrained system. Equity rotations are not noise. They are forecasts made with capital, and right now that forecast is clear. Physical assets are regaining priority as financial abundance gives way to material limits. The metal moved first, capital followed. The rest of the market is still catching up. At the core of the silver market is a problem that never shows up in daily commentary. The world consumes more silver than it produces, not occasionally, consistently. For years, that imbalance was hidden by above-ground stockpiles built during a period of cheap energy-stable trade and abundant trust. Those stockpiles were the illusion of stability. They acted as a buffer. When demand exceeded mine output, metal flowed out of vaults, and the market appeared balanced. Prices stayed calm, not because supply was healthy, but because reserves were quietly being drawn down. That buffer is now gone. When a buyer with scale absorbs months of global production in a short window, inventories don't recover. They vanish. And once the surplus is exhausted, every ounce consumed must be replaced by new supply that doesn't yet exist. This explains what traders keep misreading. Prices refuse to stay down. Every dip is brief. Every sell-off is met with immediate buying. Attempts to suppress price fail not because of sentiment, but because real demand waits underneath the paper market. When price drops on a Western screen, it signals opportunity elsewhere. Buyers who need metal, not exposure, step in. They are not trading volatility, they are securing supply. To them, price swings are noise. Availability is the signal. This is why paper control breaks down in a deficit environment. Contracts can be printed endlessly. Physical silver cannot. Eventually, paper claims must reconcile with inventory, and inventory is finite. The deficit is not a forecast. It is the present condition, and once a market reaches this stage, it does not correct gently. It reprices violently. It rations access, and it forces participants to choose between promises and possession. The buffer is gone. The system already knows it. When the buffer disappears, price behavior changes at its core. Markets stop responding to stories and start responding to necessity. This is the moment when control shifts not through announcements but through action. Every sell-off in Western paper markets now triggers the same response elsewhere. What appears as weakness on a chart is treated as opportunity by buyers operating in the physical world. They are not trading momentum. They are executing procurement. This is how a price floor forms without coordination. When silver dips, physical buyers step in. When it rises, they continue buying. Price sensitivity fades because silver is no longer viewed as a trade. It is viewed as an essential input. Demand becomes inelastic, and that single change undermines every traditional suppression model. Paper markets can still push contracts lower, but they cannot force metal to reappear. Each attempt to drive price down simply accelerates the transfer of physical supply into hands that have no intention of selling it back. Every sell-off removes more metal from circulation. This creates an asymmetric market. Downside becomes limited by logistics, not sentiment. Once physical demand controls the flow, price stops reflecting leverage and starts reflecting urgency. That is why volatility now feels distorted. Pullbacks are shallow. Recoveries are fast. The market no longer resets to comfort. It resets to constraint. The lowest available price becomes a signal to act, not to hesitate. This is the quiet authority of physical demand. It doesn't argue with paper markets. It ignores them. It absorbs supply until nothing is left to absorb. At this stage, scarcity is no longer theoretical. It is visible in behavior. The remaining question is not whether silver is scarce, but how long paper pricing can pretend it isn't. Accumulation has replaced negotiation, and accumulation always defeats leverage in the end. In a normal market, price gaps are brief. Arbitrage closes them, metal flows, balance returns. But when physical supply tightens, that same mechanism stops healing the system and starts damaging it. That is where we are now, when silver trades cheaper in Western paper markets and higher in physical markets elsewhere. Metal moves one way only, from the lowest price venue to the most urgent buyer. Not speculation, mathematics. Under healthy conditions, this flow would equalize prices, but inventories are no longer healthy. Logistics are strained, and once physical silver leaves Western vaults, it does not return. It is consumed by industry or locked into reserves, effectively removed from circulation. Arbitrage becomes a drain. The more paper prices are suppressed, the more profitable the transfer becomes, and the faster physical supply disappears. Paper contracts remain, but the metal behind them does not. Each price smash accelerates inventory loss. Banks face a binary decision. Let prices rise and expose short positions, or keep prices low and surrender physical metal. In practice, metal is sacrificed. Paper can be rolled forward. Physical supply cannot be recreated. Once deliverable inventory is gone, paper pricing loses its anchor. Contracts begin referencing silver that cannot be sourced. Price discovery fractures. Screens display one number. Reality demands another. At that stage, possession becomes the advantage. The holder of physical metal owns flexibility no paper instrument can match. The paper trader is confined by rules and venues. The physical holder is not. Arbitrage was meant to enforce balance. In a supply crisis, it exposes fragility and accelerates the transfer of real assets to those who understand the system is breaking. When a market fractures, the next phase is control. Scarcity doesn't just change prices, it changes national behavior. Once a resource becomes critical to energy technology and industrial stability, Governments stop treating it as a commodity and start treating it as strategic leverage. This is where export restrictions quietly take shape. When policymakers realize a material is essential, the logic is simple. Metal that leaves weakens domestic security. Metal that stays strengthens it. No dramatic announcements are needed. Administrative friction, licensing delays, and quiet policy shifts are enough. Silver checks in, but it doesn't check out. This marks the breakdown of the global price system. A single global price only works when material can move freely. Once flows are restricted, price discovery fragments. Multiple prices emerge, each reflecting local scarcity and political priority rather than abstract valuation. For Western markets, this is a structural shock. Years of globalization created the assumption that refined metal would always be available. Export controls destroy that assumption. When major suppliers decide to retain material, buyers elsewhere are forced to compete for a shrinking pool. That competition is not orderly. It is urgent. Prices must rise to overcome political barriers, logistical risk, and strategic reluctance. Even then, delivery is no longer guaranteed. Access becomes conditional. Contracts lose authority when governments decide security matters more than market signals. This is the point where silver stops behaving like a traded asset and starts behaving like a strategic resource. Premiums widen. Volatility increases. Paper prices drift further from physical reality. Once the gates begin to close, scarcity accelerates. Not because demand explodes, but because supply is deliberately trapped. And when that happens, old assumptions fail faster than markets can adjust. Once supply is trapped and physical metal is drained from circulation, the final illusion begins to fail: the belief that the paper price represents reality. Screens still update, charts still move, but the connection between those numbers and actual availability grows weaker by the day. Paper markets are built on assumptions that metal can be sourced, that delivery is possible, that contracts can always be settled without friction. Those assumptions only hold when inventories are deep and supply chains remain open. That environment no longer exists. As silver disappears into long-term storage and restricted jurisdictions, the paper price becomes a legacy signal. It reflects past abundance, not present scarcity. Contracts trade liquidity, not access. Volume masks fragility. This explains why price action feels distorted. Why strong demand doesn't always push prices higher immediately. Why sell-offs fail to hold. The paper market is attempting to price something that is increasingly unavailable. In this phase, volatility is not noise. It is information. Each sharp move is a stress test. Each failed price smash reveals how little physical supply remains to pressure. The market is probing its own weakness. Meanwhile, premiums tell the real story. They rise quietly and persistently. They are the shadow price of silver paid by those who need delivery, not exposure. While traders argue over charts, buyers vote with logistics. This creates a two-tier market. One price for promises, another for possession. History is clear about how this ends. When the gap between paper and physical widens too far, either paper prices rise to meet reality or the market fractures outright. In both outcomes, physical holders are protected. Paper holders carry the risk. Paper prices can be delayed. They can be managed. But they cannot override scarcity. At this stage, the question is no longer if adjustment comes, but how sudden it will be. At this stage, the goal is no longer prediction. It is positioning. The forces shaping the silver market are structural, not cyclical. They do not reverse because of speeches, headlines, or temporary pullbacks. They change the rules themselves. The first lesson is psychological. Volatility is not the danger. Confusion is. Sharp moves and sudden reversals are signs of a system struggling to reconcile paper pricing with physical reality. Trying to trade every swing in this environment is how discipline is lost and capital leaks away. The second lesson is strategic. Price is not value. Screens display numbers, but reality is measured in access. When supply becomes conditional, ownership without dependency matters more than timing. Possession removes layers of risk that no chart can quantify. The third lesson is patience. Structural shortages do not resolve quickly. New supply requires years of development, not months. In a world of trade, friction, export controls, and rising cost, scarcity persists longer than most expect. Volatility remains high, but direction favors what cannot be easily replaced. This requires a mindset shift. The objective is not to accumulate more currency units. It is to preserve purchasing power and optionality. When systems reset, wealth transfers quietly from paper promises to tangible control. Those who understand this early avoid desperation later. Ignore the noise. Watch what matters: inventory behavior, premiums, policy decisions, and capital rotation. These signals reveal stress long before